Hey everyone, Couch Investor back to another video for you today. I hope you all had a wonderful Christmas weekend or just a regular weekend. But now we're back and we're trying to end this year on a strong note. So I'm going to go over a couple of companies that we cover a lot on this channel, see what the heck is going on with them, and maybe look at sell or the buy opportunities for 2023. So in this video, we're going to talk about Roku. The stock itself has been obliterated this year, when the last year it's down more than 80% or so. The business itself actually has also been taking a hit. I'm saying this because other companies, we've seen the stock go down a lot, but the business itself continues to grow quite nicely. With Roku, the margins have been hit, free cash flow has been hit as well. Obviously with ad spending coming down and 2023 looking like a recession year as well, things might not be looking so great. I've talked about Roku and their last earnings report in the earnings report video. I've shared my thoughts there. I said I'm giving them one extra quarter, and then after that, or I'll cut or I add more. Obviously, do share your thoughts about Roku in the comments below. And of course, do not forget to submit your 2023 stock price predictions in the community post or in yesterday's video when we went over your predictions from last year. Pick 3 stocks, price predictions for 1 year from now. Write it in the community post, it will be in the top right corner as well. And I'll see you 1 year from now. So, Roku. This is how the company looks like today. Of course, the last couple of years, revenue has gone up quite nicely. Now, with regards to free cash flow, we've had, close to 2 years of positive free cash flow, which was great. Same thing can be said with return on equity, but right now, as you can see, both of them actually, if we look at gross profit margin, that also has been declining quite fast. We know that the Roku company has been taking a hit when it comes to the hardware side because they have been reducing the prices of the hardware, the dongles, the TVs, or just not increasing the prices because, with high inflation, they rather keep their prices lower than the competition. That way, they will gain more market share. But that means that the margins do get hit, as you can see here. Now, from a price to sales ratio in the next 12 months, it's trading just under 2 times. So you might say, yes, it is looking cheap, but things might be getting worse before they get any better. Now, a quick look at the ARC position here. So Roku sits at the number 6 position overall, and overall they are down quite tremendously. They have 2 positions, one at 243 and one at 254. They have a ridiculous price target for Roku. Even for my standards, I do think it's pretty insane how high they're putting Roku. And actually they have been buying more shares. As you can see here, in the month of December, they have been buying a couple of shares. More recently, December 21, they've bought just over 8,000 shares. Now, of course, with Roku, the big story in 2023 will be, can they manage to cut costs while also trying to become a bit more profitable, while also not losing that much market share? That's going to be the big story in 2023. It's also something I want to talk about in this video, which will obviously be extremely crucial if you're even a long-term investor, because if they don't survive, let's say don't survive, I don't think they'll go bankrupt, but if 2023 will look like a disaster year for Roku and they will lose a lot of market share, then maybe the bull case here will be completely dead, which is something we're going to talk about in this video. So sit back and relax. I would really appreciate it if you hit that thumbs up button and subscribe if you have not. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor. Make sure to check out all the other links in the pinned comment. And also thank you to everyone that has been checking those links throughout the year. So I want to start off with 2, let's say, contradicting notes from some analysts. So we have one positive one from Oppenheimer. They raised the price target from $58 to $70 and keeps an outperform rating on these shares. They did that after the company announced that 5% of its workforce, or about 200 employees, were going to be laid off to slow the fiscal year 23 OPEX growth without impacting long-term investors. Now, no formal update to Q4 guidance was issued, and so the analyst is leaving his revenue estimates unchanged and increasing his fiscal year 2022 and 23 EBITDA estimates. Separately, he continues to believe Roku management is getting more constructive on opening its inventory to third-party DSPs. We're going to talk about that a bit later because this might be very important. Now, on the flip side, we have a downgrade from KeyBank from overweight to sector weight. So the analyst says elements of his positive thesis, namely outsized growth in connected TV advertising and the company becoming a critical platform for media partners, have not manifested. Roku appears to be ceding market share and has greater tech debt in its ad tech stack than we envisioned. Since resolving these issues required sustained investment, consensus estimates are too optimistic on 2023-2024 revenue and gross profit growth. He believes Roku will be challenged to achieve profitability in 2024, which could pressure its valuation multiple. And if we look at last quarter's report, you can understand the concern here. Of course, if you look at streaming hours, if you look at active accounts and ARPU, yes, there is still growth there, especially year over year. Streaming hours have increased 21%, active accounts 16%, and even quarter over quarter, we've seen a nice growth there. But if we just scroll down a little bit, you can clearly see that, well, platform revenue growth is slowing down. Actually, quarter over quarter, it is down, only grew 15% year over year. Probably next quarter might not even grow. Then platform gross profit, or just gross profit as a whole, has been decreasing year over year, will probably be decreasing quarter over quarter as well. And this is why it is impacting the, let's say, bull thesis of a lot of analysts. Now, the number probably a lot of people will be looking at in the next quarter and maybe in the next quarters will be total operating expenses, because it has increased 71% year over year. You cannot increase this number by 71% when your overall total net revenue just increased 12% and your total gross profit decreased 2%. And especially not in the current market situation, this is inexcusable. Of course, they did lay off 200 employees. I don't know if that will be enough, but let's see what happens there. Since the majority is sales and marketing and then research and development, let's see if they can cut those numbers and continue to try and grow. Now, I did say that maybe Q4 revenue might not grow at all. They expect it to grow. They expect it to be total net revenue of $800 million, total gross profit of 325. Again, with the way the market and the economy looks right now, I would be surprised if they can beat those numbers. Now, another big aspect we need to think about is obviously the market share. For years and years, Roku, the OS, has been the leader, has been gaining market share. But as I've talked about in the YouTube Google deal with the NFL, maybe things might change extremely quickly. We've talked about the risks for Roku in that video, but especially the advantages that it might bring to YouTube TV or maybe just the Google OS. So I want to explain a bit more by showing you these tweets right here. This is a great thread here by Taddle Cap, who explains the whole Google and NFL ticket a bit more in depth. Now, Matthew here said that, well, by the end of the deal, I don't see how YouTube TV is not a significant platform with a much larger sub base. Cable and Roku are in trouble. Rest in peace, Fubo TV. Then I asked, by Roku, you mean next time they'll negotiate? We've talked about the negotiations in the past. Will YouTube TV, will the app still be on Roku? Yes or no? It was a whole shtick. Now, Google will have the upper hand because of the Sunday ticket, was my question. Yes, that, but more broad too. I agree with this take. The more Google gets interested in this category, the worse it is for Roku. By more interested, he means the more focused Google is on the TV ecosystem, the more likely Android displaces Roku market share. Of course, like we've seen, the last couple of years, this has not been the case. But then again, maybe in the last couple of years, Google has not been focused on the Android OS that much. Maybe right now they've seen, well, how much money they can make from it, especially since, well, connected TV is becoming the thing and cable is dying. Maybe they'll focus more on their OS. Maybe we'll see Android OS becoming the next best thing, the number one, which will obviously hurt Roku. Now, of course, bullish people will say, why not just acquire Roku? And to be honest, under $6 billion, it's a good question. And now before we end this, remember we had to talk about the third-party DSPs. So this was something that was mentioned in the last earnings call. From what I can tell, the majority of your shareholders think you're making a strategic mistake by refusing to let third-party DSPs bid on Roku-owned inventory. Roku-owns DSP is called OneView, the former DataZoom. So this leverages priority Roku data. This means Roku cannot allow the IDs to be exported, as would happen with third-party DSPs. But would, let's say, semi-answered here, are there other ways we could work with DSPs to generate incremental revenue? There might be. We're definitely looking at ways to work with partners to increase our revenue stream. Now, I think we can all agree that Roku, the product, is great. Management has a great product, has built a great product over the years. But there is one flaw here. The flaw is that there might be in over their head. They might be thinking that they are too special, maybe too big for other companies to ignore, which as we've seen, and as we're seeing right now, maybe that is not the case. And maybe they are missing some big opportunities by opening up their ecosystem, by maybe partnering up with more DSPs, more partners, more TV building partners as well. We talked about that in the past. What if Roku made a deal with a TV manufacturer instead of building the TVs themselves? Partner up with a TV manufacturer and, let's say, give TCL a percentage of the revenue, because TCL only makes money through hardware. What if they could make a little bit more money through software, which on the other hand would make Roku the exclusive partner of TCL? This has not been the case because Roku thought they were bigger than everybody else. And so it was a missed opportunity. Now, going forward, as I said, 2023 is probably another do or die year for a company, in this case, Roku. Of course, do let me know down in the comments below what your thoughts are on these possible scenarios going into 2023. Let me know all down in the comments below. If you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I'll see you all in the next one. Bye-bye.